While the world focused on rate cuts, election cycles, and green ticks on trading screens, the real event happened at locked loading docks and sealed vault corridors. What failed did not announce itself with a crash. There was no siren, no headline, no sudden halt. Liquidity did not disappear. It thinned, then detached from reality. On screens, paper claims continued to trade. In warehouses, physical metal stopped moving. This was not a confidence event. It was a mechanical one. Banks did not run out of money. They ran out of deliverable substance. Arbitrage models assumed continuity between paper claims and physical metal, but that bridge required margin, trust, and time. All three failed quietly. What remained was a widening gap between what could be priced and what could be obtained. Vaults did not empty in a day. They slowed. Load schedules stretched. Temporary delays became permanent queues. Force majeure language appeared, not as panic, but as procedure. The system did exactly what it was designed to do under stress: protect itself first. This was inevitable because the structure demanded it. Too many claims rested on too little physical reality. When system stress rose, paper liquidity stayed visible while physical liquidity vanished. Not as a surprise, but as an outcome. What follows is not a theory of collapse. It is a reconstruction of failure. What visibly broke was not the market. It was the signal. On the screen, everything appeared intact. Prices updated, volumes printed. Volatility remained contained. Commentators spoke of resilience. Liquidity, according to visible metrics, was normal. That was what the public saw. What actually happened took place away from the screen. At the dock, inside vault corridors, in settlement schedules that began to stretch without explanation. The system did not stop working. It slowed in ways that dashboards are not designed to detect. Paper claims continued to circulate freely while physical availability tightened quietly. The divergence began here, not with panic, but with delay. False stability is the most dangerous phase of systemic failure because it suppresses reaction. The absence of noise became the signal, and almost no one was listening. This did not happen randomly. It followed a mechanical chain. First, arbitrage incentives encouraged continuous paper trading because spreads appeared manageable on screen. That activity assumed that physical settlement, if required, remained accessible. It did not. Second, liquidity was removed from the physical side first, not by decree, but by cost. Insurance premiums rose. Transport slowed, verification tightened. Each step increased friction without halting paper flow. Third, margin pressure followed. As volatility risk models adjusted, margin requirements increased incrementally. Participants were forced to allocate capital toward maintaining paper positions rather than funding physical acquisition. Finally, institutional exposure accumulated. Banks and clearing members guaranteed settlement, assuming continuity between paper claims and physical backing. That assumption became mathematically unstable. The system behaved like a bottleneck. Traffic flowed smoothly on the highway, but the exit ramp narrowed without warning. Cars did not stop. They queued. And the queue was invisible to anyone not standing at the exit. The escalation did not begin with halts. It began with margin hikes. Small at first, then sequential. Higher margin requirements reduced arbitrage participation. Reduced arbitrage widened the paper-physical gap. As the gap widened, volatility controls justified further margin increases. A self-reinforcing loop. This is not new. In 1980, silver trading rules changed under stress. In 2008, liquidity vanished while prices still printed. In 2022, the nickel market halted after margin mechanics failed. Each historical rhyme followed the same pattern. Stability on the screen until the mechanism could no longer carry load. Rule changes always arrive late. They do not prevent stress. They formalize it. The signals were present, though ignored. Dealer premiums rose while futures spreads remained narrow. Delivery times extended quietly. Inventory classifications shifted, with metal moving from registered to eligible categories without explanation. Industrial buyers began sourcing outside traditional channels, indicating pressure that prices did not reflect. These were not anomalies. They were confirmations. The screen said stability. The dock said delay. And delay is how failure announces itself before anyone calls it failure. What broke next was not price discovery. It was delivery. On the screen, contracts continued to trade as if nothing had changed. Settlement dates remained standardized. Futures curves behaved within historical ranges. To the public, the market appeared liquid and responsive. Orders filled, charts updated, confidence persisted. In the physical system, something very different was happening. Deliveries began to slow, not stop, slow. Loadout schedules extended by days, then weeks. Documentation requirements multiplied. Vault transfers that once took hours now required approvals, inspections, and revised insurance terms. No announcement was made because nothing technically had failed, but the system was no longer synchronized. This was the hidden event, a friction event, one that does not register on screens. The reason was structural, not emotional. Arbitrage depends on speed and certainty. When paper claims can be created instantly but physical metal moves through constrained infrastructure, any increase in friction breaks the equation. What had been a tight loop between paper and physical became an elastic one. The causal chain was simple and unavoidable. Rising system stress increased counterparty scrutiny. Increased scrutiny slowed physical movement. Slower movement raised the cost of delivery. Higher costs reduced arbitrage participation. Reduced arbitrage allowed paper claims to decouple further from physical reality. Liquidity did not vanish. It relocated. It remained abundant on screens and scarce at the dock. Margin pressure intensified the divergence. Clearing members adjusted risk models to account for delivery uncertainty. That adjustment raised collateral requirements. Participants faced a choice: allocate capital to defend paper positions or commit capital to uncertain physical settlement. Most chose the former. Paper claims multiplied while physical throughput contracted. The system behaved like a queue forming behind a closed door. From the front, nothing appeared wrong. From the back, the line grew longer and quieter. Those not standing in the line did not know it existed. Stress escalated without headlines. There were no halts yet, no rule changes, only procedural tightening. Settlement windows were temporarily flexible. Alternative delivery locations were under review. Language softened the reality, but the effect was the same. Physical optionality was being rationed. The historical rhyme is precise. In 2008, liquidity froze not because assets disappeared, but because delivery and trust failed simultaneously. In 2022, nickel trading halted after physical supply constraints collided with leveraged paper exposure. In every case, friction preceded force. The real-world signals were visible to those who looked away from screens. Dealer premiums widened even as futures prices stayed contained. Certain bars became unavailable while others traded at significant premiums. Inventory shifted categories quietly, reducing immediately deliverable supply without reducing headline totals. Industrial users reported longer lead times and increased prepayment requirements. None of this contradicted the screen price. It invalidated it. By the time delivery friction becomes visible to everyone, the system has already moved into the next phase. And by then, reversal is no longer an option. Only reallocation is. What visibly broke in this phase was not pricing, it was participation. On the screen, spreads still existed. Futures curves still moved. From the outside, arbitrage appeared alive. The public saw orderly markets and assumed balance. What actually happened was quieter and far more dangerous. The players who made arbitrage functional began to withdraw. Arbitrage did not fail because prices were wrong. It failed because it became impossible to carry. The mechanism unfolded in a strict sequence. Rising system stress triggered incremental margin increases. Those increases raised the capital cost of holding paper positions. At the same time, physical delivery became slower and more expensive due to earlier friction. Participants were forced into a binary decision: allocate capital to satisfy margin requirements on paper, or allocate capital to secure uncertain physical settlement. Capital could not do both. Liquidity was removed from the physical side first. Not intentionally, but mathematically. As margin requirements rose, capital was pulled back toward clearing obligations. Funds that once profited from arbitrage exited physical delivery entirely. The incentive structure flipped. Paper claims were easier to maintain than metal was to move. Institutional exposure concentrated rapidly. Clearing banks and market makers continued to intermediate trades, assuming that arbitrage would eventually rebalance discrepancies. But the mechanism that performed that function was gone. Paper claims multiplied without corresponding physical backing. The system entered a state where exposure grew invisibly. The analogy is a vacuum. Margin pressure pulled capital inward, away from the edges of the system where physical delivery occurs. What remained was hollow liquidity, volume without substance. Stress escalated predictably. Margin hikes reduced participation widened divergence. Widened divergence justified further margin hikes. The feedback loop closed. Halts were discussed internally, not announced. Risk committees prepared contingency language. Rule interpretations became more flexible. The sequence is historically consistent. In 1980, margin changes in silver abruptly removed speculative participation, freezing physical availability. In 2008, collateral demands drained liquidity faster than prices could adjust. In 2022, TE nickel market demonstrated how margin mechanics can overwhelm supply realities and force intervention. Each time, the same lesson applied. Margin is not neutral. It is a control mechanism that redistributes stress upward. Real-world signals confirm the shift. Dealer premiums rose sharply even as futures prices remained restrained. Certain delivery sizes became unavailable. Inventory continued to exist on paper, but categories shifted away from registered metal toward eligible holdings, reducing deliverable supply without reducing reported totals. Industrial users began prepaying months in advance, signaling distrust in just-in-time availability. The silence was the signal. By the time arbitrage collapses, the system cannot self-correct. Prices may still move, but they no longer summon supply. From this point forward, every adjustment increases strain somewhere else. And that is when institutions begin preparing for outcomes they will not yet name. What broke next was trust between institutions. Nothing dramatic appeared on the screen. Trading continued. Settlement calendars remained populated. Public-facing statements emphasized stability. From the outside, the system looked composed. What actually happened was a rapid internal retreat. Risk tolerance collapsed behind closed doors. Credit committees met more frequently. Limits were reduced quietly. Lines were reclassified as review only. Counterparty exposure that had been acceptable for years was suddenly treated as conditional. The public saw continuity. Institutions saw fragility. The mechanism followed a familiar chain. Delivery friction and failed arbitrage had already increased uncertainty. That uncertainty fed directly into risk models. Updated assumptions raised internal capital charges. Higher capital charges reduced balance sheet capacity. Reduced capacity limited intermediation. Liquidity did not disappear, it became selective. Arbitrage incentives vanished completely at this stage. Even if spreads widened, capital was no longer available to exploit them. Liquidity removal accelerated as banks prioritized their own settlement obligations over market function. Margin pressure intensified, not because volatility exploded, but because trust evaporated. Institutional exposure concentrated inside the clearing system, where obligations could not be refused. The analogy here is a queue that suddenly loses its attendance. The line still exists, people are still waiting, but no one is processing transactions at the window. From a distance, the building looks open. Inside, nothing moves. Escalation followed procedure. Margin thresholds were adjusted upward again, justified by prudent risk management. Informal trading pauses occurred through widened bid-ask spreads rather than official halts. Discussions of rule changes began, framed as contingency planning. Force majeure language appeared in internal documents, not public notices. Each step transferred stress downward while preserving institutional optionality. History does not need to be referenced loudly. In 2008, interbank markets froze before equities reacted. In 2022, nickel trading was suspended only after institutional exposure threatened clearing stability. Panic, in these cases, was not emotional. It was administrative. Real-world signals multiplied. Dealer premiums disconnected entirely from futures pricing. Some dealers stopped quoting size. Others quoted with extended delivery windows that were technically compliant but practically unusable. Inventory reports showed stable totals, but registered categories continued to shrink, reducing immediately deliverable metal. Industrial buyers reported allocation limits and were asked to provide additional assurances before contracts were accepted. Silence became policy. At this stage, the system is no longer optimizing for market function. It is optimizing for survival. Institutions are not attempting to restore balance. They are attempting to reduce visibility. The screen continues to display prices. The dock continues to delay deliveries. And between the two, confidence thins to a procedural minimum. From here, outcomes are no longer negotiated by markets. They are administered by rules. What broke in this phase was the contract itself. On the screen, agreements still existed. Settlement terms were still published. Market participants were told that nothing fundamental had changed. The public saw continuity of rules and assumed continuity of outcomes. What actually happened was more precise. Obligations were rewritten without being canceled. This is where stress becomes formal. The mechanism unfolded in a controlled sequence. Institutional panic had already reduced liquidity. Reduced liquidity increased settlement risk. Increased risk forced legal and compliance teams to intervene. The response was not to halt markets outright, but to reinterpret rules in ways that preserved institutional solvency. Arbitrage was no longer relevant. Even if spreads widened dramatically, delivery could not be enforced on predictable timelines. Liquidity removal accelerated through procedural adjustments. Settlement windows were extended. Substitution clauses were emphasized. Physical delivery became conditional rather than assumed. Margin pressure remained constant, but its purpose shifted. It was no longer about volatility control. It was about deterrence. Higher margins discouraged participation without requiring public halts. Exposure was contained not by markets, but by compliance. The analogy is a valve. When pressure builds beyond design limits, the system vents responsibility rather than force. Nothing explodes. Flow is simply redirected. Escalation followed historical precedent. In 1980, silver trading rules were changed midstream to prevent delivery pressure from breaking the system. In 2008, contractual obligations were suspended through emergency provisions. In 2022, the LME rewrote settlement outcomes after exposure threatened clearing members. Each time, rule changes arrived not as solutions, but as acknowledgments that the existing framework could not survive contact with physical reality. Force majeure language is the final warning before failure is normalized. It does not mean immediate default. It means optionality has shifted. Obligations that were once automatic become discretionary. Risk is reassigned downward, away from institutions and toward claim holders. Real-world signals confirmed the transition. Dealer communications referenced exceptional conditions. Delivery confirmations required additional acknowledgments. Inventory reports became harder to reconcile as eligible metal dominated totals, while registered stocks approached functional minimums. Industrial demand did not fall, but access tightened. Some buyers were asked to accept cash alternatives or deferred delivery without penalty clauses. The silence was no longer accidental. It was intentional. At this stage, the system has chosen its priority. It is no longer attempting to reconcile paper and physical. It is attempting to survive the mismatch. Rule changes do not restore balance. They freeze it in place. Once force majeure becomes discussable, outcomes cease to be market-driven. They become administrative decisions, constrained only by remaining physical availability. And availability, by now, is already spoken for. What broke last was not confidence. It was access. On the screen, contracts still existed. Prices still printed. Settlement calendars still rolled forward. To anyone watching charts, the system appeared strained but intact. What actually happened was final and irreversible. Physical material stopped being available to the general market. Metal did not vanish. It was reassigned. The mechanism was triage. As rule changes took effect and force majeure language normalized discretion, institutions with priority access exercised it. Physical metal moved inward, toward balance sheets deemed systemically important. Shared vaults drained quietly. Deliveries were fulfilled selectively. What remained was inventory in name, not in function. The causal chain closed cleanly. Rule flexibility reduced enforceable claims. Reduced enforceability encouraged early extraction by those who could act. Early extraction accelerated physical drain. As inventories fell, delivery risk rose sharply. Rising delivery risk transformed paper claims into default risk. Arbitrage was no longer possible because there was nothing left to arbitrage against. Liquidity on the screen became purely representational. Margin pressure persisted, but it no longer served a stabilizing role. It functioned as a gatekeeper, preventing new exposure while locking existing participants in place. Institutional exposure reached its peak precisely when optionality reached zero. The analogy is a lifeboat system that launches quietly. There is no announcement, no alarm. Those closest board first. By the time the deck notices, capacity is already gone. Escalation at this stage is no longer sequential. It is terminal. There are no more margin hikes that matter. Halts become symbolic. Rule changes have already done their work. Force majeure is no longer a contingency. It is the operating condition. History again offers the rhyme. In 2008, settlement failed not because assets were worthless, but because collateral could not be mobilized in time. In 2022, nickel positions were canceled to prevent cascading defaults. Each episode ended the same way. Paper obligations were subordinated to institutional survival. Real-world signals converged. Dealer premiums became irrelevant because supply could not be sourced at any price. Delivery timelines lost meaning. Inventory reports showed metal still present but functionally inaccessible. Registered categories approached exhaustion, while eligible metal remained immobilized. Industrial users were forced into long-term contracts, prepayment, or outright rationing. This is the point where default risk ceases to be hypothetical. It becomes a scheduling problem. Which claims can be honored first? Which can be delayed indefinitely? Which will be settled in alternatives rather than substance? From here, the outcome is no longer debated. The system has already chosen how losses will be distributed. The price on the screen continues to update. The physical system continues to contract, and between them, resolution arrives without negotiation. What broke last was not confidence. It was access. On the screen, contracts still existed. Prices still printed. Settlement calendars still rolled forward. To anyone watching charts, the system appeared strained but intact. What actually happened was final and irreversible. Physical material stopped being available to the general market. Metal did not vanish. It was reassigned. The mechanism was triage. As rule changes took effect and force majeure language normalized discretion, institutions with priority access exercised it. Physical metal moved inward, toward balance sheets deemed systemically important. Shared vaults drained quietly. Deliveries were fulfilled selectively. What remained was inventory in name, not in function. The causal chain closed cleanly. Rule flexibility reduced enforceable claims. Reduced enforceability encouraged early extraction by those who could act. Early extraction accelerated physical drain. As inventories fell, delivery risk rose sharply. Rising delivery risk transformed paper claims into default risk. Arbitrage was no longer possible because there was nothing left to arbitrage against. Liquidity on the screen became purely representational. Margin pressure persisted, but it no longer served a stabilizing role. It functioned as a gatekeeper, preventing new exposure while locking existing participants in place. Institutional exposure reached its peak precisely when optionality reached zero. The analogy is a lifeboat system that launches quietly. There is no announcement, no alarm. Those closest board first. By the time the deck notices, capacity is already gone. Escalation at this stage is no longer sequential. It is terminal. There are no more margin hikes that matter. Halts become symbolic. Rule changes have already done their work. Force majeure is no longer a contingency. It is the operating condition. History again offers the rhyme. In 2008, settlement failed not because assets were worthless, but because collateral could not be mobilized in time. In 2022, nickel positions were canceled to prevent cascading defaults. Each episode ended the same way. Paper obligations were subordinated to institutional survival. Real-world signals converged. Dealer premiums became irrelevant because supply could not be sourced at any price. Delivery timelines lost meaning. Inventory reports showed metal still present but functionally inaccessible. Registered categories approached exhaustion, while eligible metal remained immobilized. Industrial users were forced into long-term contracts, prepayment, or outright rationing. This is the point where default risk ceases to be hypothetical. It becomes a scheduling problem. Which claims can be honored first, which can be delayed indefinitely, which will be settled in alternatives rather than substance. From here, the outcome is no longer debated. The system has already chosen how losses will be distributed. The price on the screen continues to update. The physical system continues to contract. And between them, resolution arrives without negotiation.